Well, the presidential election is just 11 days away, and many experts are calling for a Romney rally if the Republican candidate does take the top prize. But our next guest has conventional Wall Street wisdom might be wrong on this one. Jim Frischling, NewOak Capital president, is here. Why are most of the experts that are saying that stocks are going to rally on Romney wrong?
Well, I think Governor Romney is widely considered the, let's say, the more experienced and the better person to handle the issues of the economy. So I think that's why the wisdom is pushing for a stock market rally if it goes that way. But here's the issue. It's not about the changing in policies that's going to affect the market. In fact, the changing in policies might negatively affect the market reaction.
How so? How so?
I think these policy changes takes time and are focused on the economic issues, not necessarily the market issues. The reason for the rally in this market is the global coordination of central banks to make a commitment to keeping rates low and pushing people into more risk assets. That, to me, is far more important than, truthfully, either candidate in the office. And if Romney's the one talking about replacing Fed Chairman Bernanke, then that, to me, is a bigger threat. And even if either the new Fed Chairman continues with those policies, but I think the risk and the uncertainty with a Romney victory is what might spook the markets a little bit.
Okay, you know, it's interesting that you make these comments about the presidential candidate, because it seems more and more focused now from an investment perspective is being put on Congress because of the fiscal cliff. You know, we've got to have something done. It seems to me that we're going to get a deal, but it still might be a market negative, I'm being told. Do you agree with that?
Yeah, I mean, I think we've seen this movie before, and they keep telling us it's different this time, but we really believe it's not different this time. There's going to be a lot of rhetoric, and the more CEOs that jump on board talking about how alarmed they are, the more nervous I think market investors are going to get. And I do think we're going to see choppy trading and actually a pullback, especially as we reach those 11th hours. And with that in mind, we think the reentry point is going to be created by this pullback because they are going to kick the can down the road. There is going to be a compromise. And while I can't say it as that matter of fact, we have seen this, and they're going to get that done.
But I have to say, when you say getting back into the market before the end of the year, say that pullback is in the month of December, for instance, Jim, if we still aren't clear on whether or not we're going to have the capital gains jump in taxes, the dividend tax, I mean, all of those are massive market negatives. That does not tell anybody to buy stocks at that point before the end of the year. Your tax guy is going to tell you, don't buy stocks.
Well, this isn't a blind conviction to go in and willy-nilly, but I will say there are going to be very good companies that are benefiting from this low interest rate environment, and on a pullback of those companies, that is an opportunity to potentially re-enter at a better level for the investors that have been on the sidelines.
Before I let you go, I do want to ask you, you thought GDP this morning was going to come in at 1.5%, and then boom, 2%. I'm seeing a lot of skepticism about this GDP number today.
I was a little more bearish on the number. I continue to see the earnings numbers which are meeting, the revenue numbers which are failing. I thought that was a tell sign that businesses are not spending, and I thought we'd see a slightly weaker number. At the end of the day, 2% is fairly anemic anyway. So whether it is 1.5 or 2, I guess I should give myself more cushion. But I'm still saying 2% is a barely passable number.
Yeah, so still negative in your opinion. I think that's the Wall Street kind of consensus at this point. And you're in there, Jim Frischling.
Thanks.
NewOak Capital. Jim, thank you very much. All right, Dennis.